This is NWA Investing Podcast, episode 27. We have special guest Brian Wagers, local Northwest Arkansas resident. He is a investor and a partner in over 6,000 units. I'll let him tell more about his portfolio later. We also have a slight special guest. Kyle is special. We have Kyle Atkins on here. Isaac Johnson is. They just had his baby boy. Everybody's healthy. Everyone's happy. Nice, happy baby boy. So Kyle's going to fill in for him. We always love Kyle. If you go back to episode, it's going to be towards the beginning, 2, 3, 4. Kyle's going to be in there spitting some wisdom and knowledge. So we're always happy to have Kyle on. We're going to start with some brainstorm ideas that Brandon Still and I had, which is, well, we're going to talk about the Super Bowl. We just said, forget that. We're going to talk about, what do you think as a male at peak performance, you can use steroids, could you fend off
icebreaker question?
Question, could you fend off a small black bear?
I think this is where I go to the bathroom.
Yeah, this is 100%.
Brian, do you we're talking 400 500 pounds?
I mean, I think you hear this conversation a lot, and it's like gorilla or 300 rats or what. It's a black. Well, it's always this masculine. It's this. What could you take? This black bear, no chance. I mean,
that's the wholly correct answer.
30 miles per. They're surprisingly fast.
Mm-hmm.
They're big, fast guys. It's like a lineman coming after you.
Yeah,
but with claws and teeth.
Mm-hmm.
The other option was toddlers. How many toddlers do you think you could take on? Oh, man. That's just sad to think about.
It really, yeah.
All that aside, yeah.
I went 2, and they beat me down every day. So.
Well, I think here's a follow-up question to the black bear. What size of black bear would it take, pound-wise, before you're I got a chance?
Yeah.
Brandon, what's your pound-wise?
I mean, you got to be for sure 100 or less for me. I mean, they got different strength. I mean, the strength is there. It's like farmer strength. I think 100 pounds. That's a number that came to my head. 100 pounds. I think I would like to think I could do pound for pound. I'm about 190, 185 to 195, depending on the season.
Yeah.
I feel like I could pound for pound, maybe 100. I think for sure.
Yeah.
I would bet some money on that. But
Kyle, are you in the same boat on that?
Well, let's see. My son's about 60 pounds.
I throw him across.
Could you put him in a chokehold if you needed to?
Man, you skip out on the adrenaline factor. I mean, so much adrenaline.
True. Well, is the bear on adrenaline too?
All I've got to go off of is Habib when he was 5.
Yeah,
yeah. He looks better at it than I would be.
Yeah, I'm gonna go up to 150, just because if it's someone's got a gun to your head and it's 150-pound black bear, I could find their eye sockets pretty quick.
Man, yeah.
I mean, you say that's a typical male answer. It's I'll put him up to 250, 300. I got him, but
even deadlift.
Yeah. I think it's more impressive the thought process that you've put into this.
Yeah. Well, there was one I was thinking of, which someone asked me the other day. My brother-in-law, who's a professional poker player, he'll just ask me random crap, and he was like, "How many owls do you see in a day before you start questioning your reality?" And I was like, that's an interesting question. I've seen maybe 1 owl in one day before. And I was like, I think once I start getting to 6 owls, I'm praying. And I'm getting on my knees and praying at that point.
100%. Yeah. 100%. This is what guys think about.
This is what guys think about.
Women listeners.
Exactly. Yeah. Kyle actually says, I guess these questions are pertaining to the male audience. Definitely, for sure. So all jokes aside, Brian, would you kind of get us started as give us a 30,000 foot perspective of your portfolio, what you do here locally, just kind of a normal spiel there.
Yeah. So currently, before we get into my history, I buy multifamily apartments. I would love to buy every single apartment complex in Northwest Arkansas, but sellers would have a different say in that. There's a lot of expectations. I've made offers on some of these buildings right across the street here, but I was $8 million off. So, $5 million off where they needed to be at. So the next step for me was buying apartment complexes across the country. So, Dallas, we buy in Dallas, Texas, really all over Texas, Oklahoma, South Dakota, even Florida, made offers in my home town of Cincinnati, looking at Tennessee, pretty much anything but California, Northeast, business friendly, landlord friendly, red states, that's what we're going after. But apartment complexes, that's my niche. So, and I do that. I do what's called syndicating it. So I raise money from investors, and each investor has a portion of the deal. So, they're putting in $100,000 on average, and they're getting a chunk of ownership in that. And they're getting the tax benefits, upside benefits, and that's how we do it. So we raise money and buy apartment complexes all across the country, including Northwest.
Yeah. Did you start here locally, or was that your start?
Yeah, my real estate investing journey started in Springdale in 27. I actually had my whole 38 deals that I've done, and the first one was July 25th, 2017.
Sweet.
Springdale.
That's awesome.
Yeah,
Springdale.
And that was a single family. But my first my first ever real estate deal was a single family rental.
Okay.
Besides my personal home, and then the deal after that was a 12-unit multifamily in Springdale.
Okay.
So my first 3-4 years was all Northwest Arkansas and Fort Smith.
Okay. So you kind of started, like, I would say, more traditional. Then you worked your way into, I guess a follow-up question is, how did you go, hey, syndication, or was it like, hey, I bought a 12-unit, let's buy a 16-unit. Hey, there's this 50-unit, I need to figure out some partners for this. What's kind of the process to roll into a syndication type of mindset?
So I mean, it was more like, hey, I need to get invested in real estate, and what's the quickest and fastest way? And that was single family. I knew I wanted to get invested in real estate. The reason why I wanted to invest in real estate, because I was a high incomer. Right out of college, I went to University of Kentucky, moved down here, and I was doing well in sales. I made, I graduated in 2013. By 2015, I was making over $100,000 already. So
right.
And then from there, it just went up, continued. So I was maxing out my Roth IRA, and I knew I had to do something with my money. And that was, okay, stocks or real estate. Eventually found real estate, and then single family. My first ever, actually, I house hacked my first deal. I didn't even know what that was. I rented out one of the rooms to my girlfriend, who's now my wife, and then I rented out. I didn't make her pay rent. So it was really
tax benefit,
and then I rented out one of the other rooms to her friend too for 6 months. So that helped kind of get the bug, and then I did the Bigger Pockets training School of Education and read every single book I could from them, and then I bought that first single family in Springdale, and that was, from there it was, this is way too slow to get where I want it to be. I've always had a sense of urgency, straight out of college, I wanted to, as shallow as it is, I wanted to make as much money as possible, and that was, it was because I had a sense of urgency. I never got complacent. I'm still not, happy. I'm happy, but I'm not satisfied.
Right.
Where I'm at. So, that first single family, then, I just did the math. It was like, what am I going to buy? One single family house a year. And then 10 years from now, I'm going to look up and I'm going to have 10 houses and making maybe $100,000 a year from that, depending on where that's at. So it was
right.
10 years of hard work to do that. I don't know. That's not really the trajectory that I wanted to go. So then commercial real estate was the next thing that I was looking at.
Right.
So what made you kind of originally think about real estate? Was it just searching around for the next investment vehicle, or was there family that maybe had been in real estate before, or where did that kind of desire come from?
I don't think I had it. I mean, my mom's side, there were a lot of entrepreneurs. I think my grandpa had some rental properties, but he always complained about them. My parents definitely didn't. It was just I had an income like a lot of my investors now. I had an income problem. I was making a lot of money, and I was maxing out my Roth IRA, and I was like, I need to do something with my earned income. I want to put it to work, and it wasn't that I was looking to replace my earned income. I was looking to put it to work. So. Mm-hmm. And start building off of that. And that's when I saw the opportunity there in commercial real estate.
some of what you touched on earlier was like the being happy and satisfied and stuff. And I think I have some stuff in here where I kind of want to dive into that later, which is like the mindset behind like, a lot of guys that are high income earners have to ask like, when is enough enough? Is that even a question? Is there a spot that you're going for? And so I really kind of a follow-up question, like, is there a goal in mind? Is there like hey, once I hit here, there's like halos and angels that come out, like once I've hit this number? Or is it like just, hey, just keep working hard because that's what I know how to do?
I think that's a moving target, like that number. I think it's more like more of a, what does my day-to-day look like? Is it a goal? Like more, I have the ability to create my own schedule now, but I still have to take calls, and I still have to, conduct order business and everything like that. So I think for me, I don't know if it's a certain number, I mean, that when you're in college, you're like, I want to make my first 100,000, and then you make your first 100,000, you're like, okay, I want to make 500,000, and then you're like, okay, I want to make $1 million, and then like, okay, I made $1 million, now I want to make $5 million. So I think it's kind of a moving target. And I think, it's something I'm definitely always thinking about.
Right.
I don't think I have an answer as far as, certain income. I think units wise, my company that I'm a partner in, we have 6,000 units. I'd like to have 10,000 units. I think that's kind of where I'm looking to be. I don't know that I'll ever want to have like 100,000 units or some sort of like, Blackstone or anything like that.
Right.
I think 10,000 units, and then I'm going to slowly start buying like build for rent communities and more A-class properties where it's a little bit more passive. You don't have quite the upside as these major fixer-uppers, but you also don't have the downside. So I think, slowly building out that portfolio of really like, a little bit lower leverage portfolio, a little bit more passive portfolio.
Right.
I want to back up just a little bit, because if I had to guess, 95% of the people listening to this are not syndicators, nor do they even know what it is.
Yeah.
What? So, yeah. So I want to ask y'all, you can explain it. Syndication is a little bit of a different animal, but there may be somebody listening that has the money to do what you're doing with you, or something like that. So, I'd use this as an opportunity to, I guess, quote unquote, sell yourself too, but just kind of explaining the process of actually buying in, what that looks like. You've got your partners on the company side, but they're buying in on the real estate side. Just kind of share a little bit with.
Yeah. So syndication, I mean, you could look at it even just you can syndicate anything. You can syndicate apartment complexes, you can syndicate businesses, which is common. You see it on Shark Tank. These operators, the people that run the business, they go in and they're looking for investments where they're giving up 20% of their company for $5 million or $10 million. So they're looking for that capital, and then they're willing to give up a piece of their ownership. So we're doing that with apartments. We kind of flip that model though. We as the active partners, me and my partners who are running the day-to-day, finding the deal, managing the deal, making sure insurance is set up, managing the property managers, making sure we see an exit through, managing the construction side, everything that goes into an apartment complex and running the business. We're getting, probably 20 to 30% of the deal, and then we give our investors around 70% of the deal.
Wow.
So for investing. So, a $10 million apartment complex, we're raising maybe $3 to $4 million, and someone comes in with $3 to $4 million, they're going to have 70% of that deal. But they're not going to have any control. They're not going to have any control right. They're silent partners. They're just, I guess, so similar. So the difference there on the Shark Tank model I just kind of described too is those investors have no control. Like, it's just passive investors. So they're also protected that way. If anything goes wrong liability wise, they're only risk to the amount that they're putting in. But
right.
What's the shakedown look like for that, for somebody that invests $100,000? They come to you and say, hey, I got $100,000. I don't have time to look around, find for myself. You guys do it. What kind of return can they expect?
We try to average 20% average annual return. So that's a mix of cash flow, and most of that's come from your biggest bang is at sale. You're forcing, just like a business, it's evaluated on its net operating income. So you're forcing that net operating income up by managing expenses, pushing other income, and then you're increasing the valuation of the apartment.
Yeah.
And that's when you get your big bang there at the end. So we try to hold, typically we model out for 5 years. In 2021, 2022, I was, 2xing, 3xing some of these investors' money, but it's not the same market anymore. Interest rates are and so it's, we were selling in 2 to 3 years, and some of our models now 5 to 7 years, but I think 5 years is a good hold time. So
what in the last couple of years, what have cash calls looked like, beyond their initial investment? Have you guys found yourself going back making cash calls?
Yeah, my first actual cash call was to my girlfriend, who's now my wife. I did a seller financing deal in Springdale. It was a
cash called yourself.
Yeah. But it was a 2020. It was a 22 unit seller financing deal. Highly leveraged. I didn't have the money to do all of the money myself. So I was doing seller financing in the beginning on these 22 unit deals, and my debt to income was really good because I was a high income earner. I bought it with like no reserves or no, it was the CapEx, the bank financed the CapEx, and some of that down payment I raised or put extra towards that too. But I mean, it was not cash flowing at all for 2 years, and I was putting money from my job into this apartment building, and then I had to ask my wife, who's my girlfriend at the time, for $10,000. But that deal ended up being part of a portfolio that I sold. That was my first ever 7-figure check.
Yeah.
I had no investors in that deal. It was just me. I built up a portfolio of these seller financing deals for about 64 units, and that ended up being my first ever 7-figure check because I was able to put extra money that I wasn't accounting for, and she lent me that. So it was one of her better investments.
Yeah.
So say you give her $11,000.
She
at least
she is now. Yeah. She is full-time mom and a dream house with whatever she wants. So
yeah,
she locks down the family and the home, and she definitely deserved that. But yeah, I mean, we have C-class deal and Houston that we've had to ask for additional capital to. It's not fun part, and it's definitely not part of the projection, but you don't want to buy deals with floating rate debt. You don't want to buy, C-class deals are getting hit the hardest right now. You have inflation at its highest. A lot of these guys are having trouble paying rent. When we did that too, rent relief went up. That was coming off COVID. They had, Texas had rent relief, then they let go of rent relief. We had criminals on the property, and everyone stopped paying rent. Like something, you had a couple bad apples, and they like tell the whole everybody there at the apartment complex. So it was like just like you have one wrong thing, okay, you can weather it. But we had like all these, and we didn't have good property management on there too.
Yeah.
So
2 questions in regard to the syndication. As far as the structure goes, so just in case there's somebody listens to say, I want to do that one day. Are you having them actually buy into your company, or are you actually having them buy the real estate itself, and then your company and your entities held separately?
It's held separately, yeah. So we formed just like I had like 38 LLCs, for all the 38 deals I've done. Each property has its own LLC. So Watercolors here in Northwest Arkansas, it's held under Centerton 376 LLC. So those investors have an ownership piece of Centerton 376, which is the owner of the apartment complex.
Yeah.
What do, I know syndication's a different animal. What are you guys getting like as far as debt to equity right now in terms of what banks are requiring? What are they requiring you to put down?
I just had a lender panel at a commercial real estate meetup, and the common theme was like 70% is the new 80%.
Yeah.
Like back in the day, it was like 80% leverage, and when I was doing it, I was getting 80% leverage and seller financing leverage, and I was like at 100%. And now it's we're looking at 65%, 70% leverage. Which
I was listening to the reason I was asking, I was listening to Ken McElroy the other day.
Yeah.
They were doing a $400 million deal, and they were working with a bank out of New York, and they wanted like 55% down.
Yeah,
It was
crazy.
insane.
That's for ground up construction. You're looking at that too. So we are looking at some development deal. We haven't done any recently just because it's so hard to pencil. Because the banks, you want less, they want more down. Higher interest rates, and your return on the problem with the leverage is your return on equity goes down when you have lower leverage, but your risk also goes down too. So you have this risk reward, and it depends on your investor's level of comfort. It depends, maybe a highly leveraged deal isn't for this investor. They want to do the next deal. So some people do funds. We have a fund right now that's more of like an income fund, but we do it deal by deal. So someone might not like Northwest Arkansas deal, but they'll want to do the deal in South Dakota, or they see this deal as a little higher leverage and there's a greater return on equity, and they'll do that deal. Maybe they want just higher cash flow, so they'll wait for a cash flow deal. So I think there's different preferences, and that's kind of why I like the syndication model, because you can do each deal separately and it allows your investors to diversify, allows investors to pick and choose which deals they like.
Yeah. Let's kind of go back a little bit to like when you were getting started finding these seller finance deals. Like you said 2017, 2018-ish, in that range. How are you finding those deals? Was it like just balls to the wall, calling people or door knock, or what were you doing?
All the above, calling people we did the driving for dollars. My wife, get another shout out here. Now she's earned her, full-time mom status. Is she would drive my car, and I would take pictures of all the crappiest looking apartments I could find in Springdale. And send them a letter in the mail and say, hey, I'm buying apartments in the area, and reach out to them. And I got actually 0 deals that way, but when we were driving one day, there was a for sale by owner on one of these like really dilapidated looking apartment complexes, and I called him and I was like, hey, are you selling this? And he's like, yeah, I actually have 12 other units I'm selling too. So, and to get to the price he wanted, I did the seller financing deal, and the seller financing was it's a pitch to the sellers too, that you're deferring some of your capital gains tax for the first year. You're also getting some monthly income. It's, less, if I stop paying, you just take your property back and you own it again. So, it's kind of on how you pitch them. But some people just want like I wouldn't really do a seller financing as a seller. I want the cash so I can reinvest it. But it depends what their goals are. If they're not looking to reinvest it, just looking to nest egg it, then that's that. But another way I was talking to commercial brokers, making a lot of good relationships with local brokers.
Even before you started buying units, you were connecting with those brokers.
Yeah. So I think, that was after the first, that single family deal, my chest stood up a little. I'm now an owner of rental property real estate. And then the 12 unit deal, it was actually on the MLS. Some of these smaller deals, you'll see if you set up realtor.com notifications, you'll get the notifications anytime multifamily. And a lot of these small multifamilies 4 unit. Well, I consider multifamily 5 units and up. This is how a commercial bank does, but they'll come on the MLS. So that first 12 unit was actually on the MLS too. So I think with anything for me, I was trying to buy multifamily however I could. Seller financing, I wanted to find it however I could, whether that was through realtors, through myself, or through the MLS. So I was hitting at all angles.
That's amazing. As far as like, so you said you have basically things going on in multiple states, correct?
Yeah, we do.
What do you see like, what's your projection or outlook for the Northwest Arkansas area for, let's put you in the shoes of someone listening to this who's like, I really want to get invested and start, and they're like looking at different areas of the country. Like, what's your case for Northwest Arkansas? Do you see favorable projectability?
Yeah, I see a lot of favor. I mean, there's only so much the Northwest Arkansas can grow. Obviously, you have the Pea Ridges, the Gravits, these tertiary markets, but people are only willing to drive out so far, and there's only so much land here. I think if I had unlimited amount of money and I didn't really care about returns, I would buy as much as I could here. I think there's still a lot of growth. There is a lot being built here, so you do have to be careful about just paying for whatever. But I think the case here is you have J.B. Hunt, Walmart, and Tyson. These behemoths, and obviously Walmart having the initiative of if you're selling to Walmart, you have to have a home office here.
Yeah.
So that has had tremendous amount of growth, and it'll continue to have a lot of growth. The Waltons have made it very clear that they're not moving, so you have that risk of Walmart leaving, not gone. Tyson also made it very clear, same with JB Hunt. Then you also have University of Arkansas. It's like the 8th fastest growing university right now. So there's a lot of good factors coming into Northwest Arkansas. There's so many. I mean, it just went up. It's always the best place to live. You see, it's the fastest growing economy. So there's so many good factors coming in here. And you look at the growth. When you're buying, you want to be conservative on your growth assumptions. Even living here, I think. Yeah. That's why I like buying out of state. It kind of takes the emotion out of it, because we lost out on a deal here like a couple weeks ago and about $1 million off. But I was like, I was really vested. I wanted to do another deal here locally. I had that emotion to it. But when you're investing out of state, it kind of takes the emotion out of it. You're not driving by it every day. So, investing can be emotional, but you want to try to take emotion out of it and look at it on the numbers case. So
How do you... Is it really hard to do that here when you spent so much time and so you drive by something, you're like, man, I'd love to have something right there. Does it make it really hard for you?
I think so. Yeah, it definitely does. And I think, maybe some local investors are okay. They would rather get a 15% return investing in Northwest Arkansas than they would getting a 20% return investing in Oklahoma City. They would be okay to have a little bit less of return, knowing that they could go drive by something and touch it. So
I think what you just said is super accurate. A lot of us get, I don't know what the correct way to put it. Like some people, it's like talk about the drunk vision or whatever. It's kind of like NWA vision. Like we have a bulletproof vest on here. Nothing can ever affect us. Like we got this, and this. Nothing's gonna happen. I'm just gonna buy here. I think you have a really unique perspective because you're able to see multiple different markets and be like, I think Kyle said this multiple times, I get this from him, as like anyone that says we're like indestructible is most likely wrong. I would hate to, spend all my money for 20 years here and then, it's gonna go down at some point. I mean,
I think there's a layer of insulation in Northwest Arkansas. We've already seen it when interest rates were at their peak. Home prices were still selling. People were still having trouble buying homes. Homes were still flying off the shelf. So, maybe I'm not as involved in the single family space. I couldn't tell you, but I know what average days on market went from 15 to 30 days, or it went up. It was other markets. It was 60, 90 days. You're seeing these home prices still increased here. Other markets, they went down 10%, 15%. So you already have this case study of a down cycle and NWA being resilient in that down cycle. And commercial real estate is in a very down cycle, especially office space, down 30% across the board. Multifamily, C-class getting hit too. So NWA already has this case, a couple case studies of COVID, of this down cycle that we're currently in, where it's been resilient. So there is definitely a layer of resilience, and I'm more aggressive in Northwest Arkansas when I'm looking at numbers than I'm looking at other markets. Houston, I'm way more aggressive in Northwest Arkansas than Houston. Dallas, I'm almost just as aggressive as I am in Dallas and Northwest Arkansas. Some of these other growth states. It's just when you're underwriting a deal, you want to look at how long you're holding it for, and what are those Yes, NWA's rents went up 10%, 20%. It's not going to go up 10 to 20% every year. It's going to continue to go up. I don't think it's, maybe there'll be some flat lines or maybe some stalls. I don't think it's going to go tank by any means. I don't see NWA tanking ever, but I don't see us sustaining the same rate of growth. I think it's going to continue to go up, but at the same curve, probably not.
I think there's some level too. I was talking to one of my investors the other day that's he's just sitting on a bunch of cash, and I was just saying, all right, teach me. What keeps you from buying a property that's got a 7% return? He was like, T-bills. Yeah, it's 5%, and I don't have any liability. I don't have any renters. I don't have anything. So I think that's seems to be a lot more of the challenge, but it also provides some perspective to like the Oklahoma City deal. There's a lot of people that'll take a 15% return here versus a 20% return there, and because of the insulation that you talked about, because of future appreciation opportunities and things like that.
Yeah.
I think the thing that a lot of people get stuck on is just like what the nominal return is. They take out the impact that inflation has. You know, like you hear people all the time, they feel it at the grocery store. But then we have single family. I'm talking about single family. You got single family houses that are going up. You know, the trajectory on paper is also up. But I think at some point too, you also have to look and start asking yourself the question of, you know, what is the dollar buying me today versus while it's on the way up? How far is my dollar getting me versus what it was a year or two ago? And I think those conversations are complicated. They're super complex. But with inflation where it is, I mean, yeah, I think on the chart and the numbers wise, you'll always see them, you know, not always, but for the foreseeable future, you'll see them up and to the right.
Well, Joe-flation.
Exactly.
Decision is hard for sure. Yeah, you have to factor that in. I mean, go to the grocery store, go to the gas tank, you see that. So, I mean, real estate is the best hedge against inflation, hands down. So I think you just have to look at it at a risk-adjusted basis. Where are we going? And what are you willing? Maybe you are okay, I'm just going to do T-bills for 5%. Or, you know, you have some of these some of these banks, a lot of these banks want deposits. RBS isn't worried about it. You know, they hold the Walton's deposit. They're flush with cash, you know.
Yeah.
I actually heard recently that they are now wanting deposits just so they get deposits away from other banks. Not because they need it, but just to reduce the competition. But people are willing to pay those deposits. We're seeing like 5%, you know, 4.5% just for these high money market. But that still doesn't, to your point, beat inflation. Inflation's 8%, or reported 8%, but what is it really?
Yeah, reported.
I think that's a great point. I mean, I think if you're going to build a life around investing, like you need to have a general understanding of what the CPI is and what it makes up. You know, at one point in time, 44% of the shelter cost was part of the CPI, and you look in some cases, and you know it may fluctuate as low as 38%. Well, wait a minute, how'd that happen?
Yeah,
you know, the CPI went down, but everything else still, you know, housing and utilities. The utilities is the other big one. You know, housing, but those things are just holding up. You know, they're not going down anywhere. They keep climbing.
Yeah.
That's one thing about NWA, I think, is the cost of living is amazing here. Like still relatively, you know, compared to anywhere else. Dallas, pick your home up and put it in Dallas, it's going to be 3 times. Depending on where you're at. And in Florida, even, you know, 5x that.
Yeah.
I think it's also too in what you're doing in syndication says it a lot. I think there's a lot of people. It's a hard conversation to explain in a short period of time, but you see a lot of people that are saying like, "Oh, my home has gone up in value this much." You know, it's like actually the dollar's just worth less. You're buying money, and it's being backed and held by the asset, in which is terms of real estate. But you're buying money, you're buying income, and it's just being backed by that asset.
Yeah.
Yeah, you have to adjust for inflation for sure. And to that point, we're just looking for like doubles and triples. Like 2021, 2019, 2018, we were hitting home runs, grand slams. But right now, I'm just looking for risk adjust. Like what's the basis? What's our basis right now? And what can we conservatively grow at? It's going to be hard to like get home run deals right now, but we want to protect our downside and still make, you know, solid returns. That's what we're looking at. You know, 2 baseball guys. We're looking doubles and triples right now. We're not looking for runs.
I love that you use that analogy. I use that with a lot of my investors. I'm like, hey guys, especially when I'm personally talking to a lot of people that are like looking for their first one, looking for a second or third. I'm like, but I know you want a home run. We're going to get a single or a double, and then maybe we hit it over and score them in or something like that.
It's money ball. We're just getting on base.
Get out there.
You think multifamily's accelerated past where Northwest Arkansas is as an economy as far as pricing goes and what things are trading at as far as cap rates and stuff like that?
Yeah, I mean, you're still seeing low cap rates here. You're still seeing a lot of like going back to the basis conversation, people are used to paying, you know, $300,000 a door in Texas or Dallas or even California, New York. You know, they're willing, $250,000 a door sounds great here, you know, on a multifamily to them if they're looking at the basis.
Yeah.
Maybe it is. Maybe I've seen some of these big time funds, they're putting up $1 million hard day one. No, it doesn't matter what happens in due diligence, they're coming in. So that's like, what do they know that I don't know? These guys who have that much money, they have that much money they're coming in. Maybe they know something that I don't know, that they're willing to put that much in there.
That's a great question to ask when someone's like that's doing something. You're like, all right, like either they're stupid, which they're probably not, or like I'm doing something. A question for you is like, you started off hammering hard for finding the deals and stuff. How are you finding deals today? Or
we have a director of acquisitions. So I mean, I still have a lot of relationships with commercial brokers from my days of just finding deals. And now I'm focused on the equity. I'm a partner at our company Elevate, but so I wear a couple different hats. I still have a hand in acquisitions, but my main focus, I'm the CIO. So my focus is on equity, but I still oversee some, like I'm talking to the asset manager because I have to tell my investors too, and some of our local assets. But commercial brokers are a really good tool for the larger deals. Those are the guys that are hammering phones, so they're the guys that are building relationships with these sellers for years sometimes, and they have the right. But we're still doing some direct to owner outreach too. We're talking to a lot of developers right now that have maybe their costs have gone up. They built for this. They put a lot of money into building, and they're realizing, they couldn't quite get where the rents were there they needed to be at. They may have overbuilt. So that's one of our targets right now is other developers that are looking to exit and get out of their high interest variable construction loan. So we're going direct to developers and owners.
Swoop down and rescue them in person.
Yeah, and then there's still like these C-class deals that are like in trouble and like had variable rate debt, but we've looked at some of these deals that have been foreclosed on, but still couldn't even make sense of the numbers that of the original debt that they had on the property. So it's still we're still going after C-class deals. It's just hard to pencil them. So it's hard to get any deals to pencil, really. I mean, the last deal we did was in December. It's February 20th, or something like that. So,
well, the other thing that's really hard too, that unless you bought a lot and flipped a lot and restructured and done all that, it's hard to sit down and explain that rents are behind 12 months. So when you're buying these deals, somebody's in a year lease, you're not going to see that lease come free for a year. And so you're looking at these prices today and you're going, all right, well, can I hold that for 12 months? And then can I make that work? And honestly, there's a lot of people who have done really well, but they probably had a big cash reserve. And, in hindsight, that's what was so hard for me to predict through, 21 or 20 and 21 is you've got rent's going up 30%. And so it's like, well, if you could see into the future and see what's around the corner in 12 months, like that's a great deal today. It didn't work, but it's a great deal next year. And that's really hard to do. It's for me personally, it's a gamble I'm not willing to take, but I've seen a lot of people make it work.
Yeah, we pay our acquisitions guy he's in the six figures, so he's very good. He's our analyst too, so he's running those numbers like better than anyone I've ever seen, and it's pretty cool seeing like him analyze that stuff. I was using kind of like some Excel sheets when I was buying family, so I was like, hey, his worst case scenarios, best case scenarios are unmet. It's really cool to see, and that was a more recent hire that it was a great investment by us. Like,
what's that done for your life?
It's taking a lot off our plate. He'll go back in and look at how we underwrote deals and how they're performing, and especially on the acquisition side, I think it's back to that protecting your downside right now. It's like a huge thing. You want to protect your downside, so it's really
explain in layman's terms for everybody what you're saying about protecting.
Like not losing your money, not getting into a situation where you think rents are going to increase 300. This is an easy example, but you can't increase rents $300 every year. So, but some people may have underwriting. Okay, I'm going to increase rents $300 this year, then increase rents $100 from there. But you want to go in and not do what happens if I go in and don't increase rents at all? What happens if I go in and 10% of these guys move out? What happens if they and they don't move back in? What happens, if cap rates don't go down, or what if they go up? Everything that we're underwriting for is cap rates are going to be higher than what they are going in. If we're buying at a 5.5 cap rate, we're going to say in 5 years from now, it's going to at least be a 5.5 or higher, even though I personally think, I'm not going to put that on paper. Personally, I think cap rates are going to be from where we are at right now in 2024 and 2029, cap rates I think will be lower. But I'm not putting that on paper. When I'm analyzing this deal, I'm not.
What do you think B's and C's are right now? Probably 6.25, maybe 6 in the right spots.
Yeah, Northwest Arkansas, I would say 6 for sure.
Yeah.
I think that's A-class deals for like 4 caps.
Yeah.
You know.
Yeah.
There's some storage still going at 3, and I'm like, oh,
It's subsiding.
Yeah.
A lot of storage around here. If you were kind of a perspective question, if you were, say, when did you when 2017, how old were you?
That was what, 8 years? No, that was
a long
time ago, man.
That was 7 years ago, 7.5. Yeah, it was about 7.5 years ago. So I was 23. Yeah, I was 20. I'm 32.
Okay. So if when you were 20, looking back at 23, would you take the same path you did?
Yeah, absolutely. I mean, I try not to have any regrets, just as a way of living, and everything happens for a reason. I think, you get put in whatever situation you are, whether it's a good thing or a bad thing, you're going to learn from it. So I'm happy that I did everything that I did.
And has real estate provided? I'm asking these questions because some of the audiences probably think the same stuff. Like, has real estate provided you with the lifestyle that you've dreamed and hoped you want? Even let's say 3 or 4 years ago, like not where you are right now, would it have provided a lifestyle that you would have been really happy with?
Yeah, 100%. Yeah, we live in our dream home. I got a pool house in the back that's now just full on gym, 2-story. It was a 2-story house behind our house. I was like, Jen, you do whatever you want to the main house. This is mine. This in-law suite is now going to be mine, and it's a 2-story gym with sauna, cold plunge, like squat rack, full cable machines, everything like mirrored up, and and then Jen has we both have nice car. Her car is paid off. My car, I was like 3.5%. I was like, I'm just going to finance this one. But I could have paid it all cash, and we're still living below our means.
Right.
We're still living below our means, and I think that's a principle, especially in success period. But I had my first 7-figure check. I had a Acura that I had for 8 years at the time. Didn't have AC in it. Like I was still rolling around in that car. I was living in a house that was way below my means. And, I think, because I did that, live below my means, I was able to reinvest a lot of that. And I still try to reinvest a lot of that. But, I am able to travel around the country whenever I want to, and not have to think about, we take our 1-year-old, we fly first class with our 1-year-old. It's nice. It's nice to have him and those seats. And it's not even, it's no brainer to have that. And so I think, it definitely has paid off, and it's going to continue. But at the same time, I'm still, looking to grow and still looking to position myself further.
That's amazing. I'm trying to think of like the audience sitting here. With that first seven-figure check, how were you even tempted to go like, oh, I could do this, and this, or like I could go buy a couple Rolexes, I could go do this? Was it even a thought, or was it like
I was never? That's the thing. I've never been a watch guy, or never been. Maybe because I didn't come from money, didn't ever become a watch guy or become a car guy or anything. I have a nice car, but but I was never a car guy or anything like that. And for me, it was like excited to like what I can do with this, like how I can reinvest this in myself and reinvest this in my business.
Does that kind of unlock feel like in your brain, like once you're like, oh, like we can really do this, like going forward?
Yeah, I think I had unlocked that. Like, I think you keep unlocking that, like as you keep, like with almost every deal, and it's you learn something from each deal. And I think for that, it was a big moment. And now all my syndications, anytime I put a deal out, I'm investing as a limited partner too. Every deal that I put out, I'm investing at least $100,000, not on the other side as that limited partner. So I have the same skin in the game as one of my investors. So I have my general partnership ownership, but I also have ownership as a limited partner. And that's one of my goals, is to just be fully invested as a limited partner, maybe be on a board, like an advisory board or something like that, I think. But
I think the best thing you've said all day is that there's been multiple deals. You just put the pencil down. And I say this all the time, for young people that are listening, like, it's just not something you can be emotional about, which you briefly talked about that. And to be able to put the pencil down, one of my lines I use with Zach all the time is, you have to have the willingness to buy everything that hits the market and the discipline to say no to every single one of them. But, you're working them, you're doing them. And it's probably, for me, just listening from over here, that's probably been the best thing you've done a lot of times, is just put the pencil down.
Yeah, 100%. I think so. I mean, in the beginning, it took analyzing so many deals, and it took, before I even got that first single family, I made about 18 offers on little single family homes in Springdale, where I got. But for those 18, I didn't just underwrite 18 deals. It was, I underwrote 40 deals to get to this 18.
Yeah. Well, I did it for me, like, it's not good for business, but I like long-term clients. I sell real estate, but I've told a lot of people lately, just don't do that. It's just not, you see so many people trying to get in, and they've got the quantity of, 4 or 5 homes, and they're cash flowing $1,000 a month. It's a lot of stress, overhead, one tax hike, one insurance bill, which, by the way, another one's coming, by the way. That one's not going to get any cheaper.
Yeah, for sure.
Arkansas is one of the last behind, and insurance wise, we had more, I think we had more claim dollars last year, if I'm saying that correctly, than California.
Wow. I heard that.
Yeah. So, I mean, those things just keep coming, and to just have the discipline to say, hey, like, I can hear it in your voice, and like, we hadn't bought anything since December. It's a pretty great thing to be able to do, to be able to move on what you need to move on to, but also be able to say, push yourself away from the table and say, yes, it's not good right now.
Yeah. And that's not to say, like, just because you aren't moving forward, like, still stay active.
Yeah.
We've made, like, since December, I don't know how many weeks that's been, but we've sent out at least one offer a week since then. We're our guys underwriting deals every day, and we're submitting offers at least one offer a week, like, with the intent to buy.
Yeah.
And
give us your biggest lesson learner. What's the worst one you've ever done? There you go. Oh man. Oh, not that you regret it, because you learned a lot from it.
Yeah, exactly. I don't have, I try not to have any regrets. I mean, that the deal in Springdale was pretty scary at the moment, when I was putting income from my job into the business, and then asking my wife my girlfriend at the time, for money. So that was pretty scary at the time.
Yeah.
There's been some, I've over rented, when I was my first 12 unit in Springdale, I was like really gung ho and really excited about, and I put like 6-inch graded, I wanted to redo the parking lot, and I spent like $40,000 on this parking lot, and I could have just repaved it, but I was like, this is going to last for the guy like sold that part.
They're going to care about this.
Parking lot guy like really sold me, and I was like, that's going to last for 30 years. I was like, I ended up selling it like 3 or 4 years later. Okay.
That was the main selling point.
Yeah. I would say that, that C-class deal that we did in Houston, that was obviously, one that, look back, like, probably wouldn't do again. Obviously, that's back to those things, is the variable rate debt and the C-class problem. So what you brought up too is, you want to make, like, insurance and taxes are going up. Like, we talked about making sure you're conservative on rent growth, but make sure you're conservative on pushing tax growth and insurance growth, and get professional opinions on that. We pay for these, apartment complexes are tens of millions of dollars. We get professional tax advice too, like, on what we think, where we think taxes will go to now. So we'll pay for that once we're close on the deal.
Well, it just doesn't take much. I mean, this is not to scare anybody at all. You should continue to move forward. You should continue to buy property and do all that. But just, in your due diligence, like, when you're buying that first single family home, and, you're cash flowing $500, that first tax assessment, or, whatever it may be, you move out, or even like myself, we have a 16 unit deal, and, insurance in 1 year went from $9,500 to $25,000, a renewal. And just try, you just have to be diligent about those things, and it's even more so in what you're doing, because it's fine to blunder a 2 to 3 unit deal. I mean, but you start taking
times that by a couple hundred.
You start taking $50 a unit times a couple hundred units, and it adds up pretty fast.
100%. I think going to now we've kind of seen them. I think back in 2018, 2019, no one knew that interest rates were going to go from 2.5% to 8.5%, or knew that insurance and taxes were going to go. So if you're just now getting started, you're almost in a better position than you were if you were just getting started. You've seen what's happened, so you don't have to have any of those seminars or learning mistakes of the numbers going up. So now you can be more conservative going forward without having to actually gone through it.
Right. What's so great right now is, there's a deal to be had in every market. You find the right deal, there's a deal to be had in every market. And people will ask a lot about the interest rates. There's probably not a better time to buy than right now. If you can make it work at 8%, then it'll for sure work at 6%. So just being diligent, continuing to run the numbers. And
what if you have a young investor who's sitting across the table from you, or I say young investor, haven't even invested yet. They got $60,000 in their bank account. I'm trying to speak from our audience, and they're like, Brian, what would you do if you were in my shoes? Would you just say, hey, go find start with that single family, and then just compound, or what are you telling them to do?
You'd save $40,000 more, and you can go in.
I get those in the DMs all the time.
Yeah,
especially because of my story and my age, of how I scaled. But if they were to have $40,000 more, they'd have to be accredited investor. They'd have to make $200,000 or more, and a lot of times they don't. But I would say, what are your goals? Are you looking to make real estate your full? What are their goals? What for your listener? I guess they're probably wanting. Are they wanting to be full-time active investors? Or are they wanting to be passive?
I think people don't even ask that question. Don't even go that far.
Yeah, I think they need to, before they okay, I want to get into real estate, but they need to take a step back and what do they want to get out of real estate? I think is a good question for them. Are they looking to replace their income, or are they looking to make that a full-time position? Invest in yourself first. Get educated. Read as many books as you can. Listen to these podcasts. Listen to as many as you can on your commute to work, in the gym, or wherever you can, and really get educated, and then kind of figure out what you want to do with real estate. There's a million different ways to make money in real estate. So many different ways, and I think it's picking the vehicle that you want to go, and how active or passive you want to go from there.
That's great.
I would also butt in and just say that you were talking about making friends with the lenders. I think one of the biggest mistakes that people make, I talked about this a little bit the other day, is how people work their relationships with property management companies. They're not great to them, to be honest, and a lot of times you're tripping over thousands trying to pick up hundreds, and have as many relationships there as you can, because a lot of times they know that those deals are hitting the market before anyone else does. And so just maintain those relationships with your management companies too, and treat them well. Whether, I'm sure you guys are doing in-house management but for the people that have 2 or 3 properties, that build those relationships, stay engaged with them, and continue to be involved with what's going on.
Yeah, I love what you said about taking that first initial step back and be like, do you just want to get 10 homes and then just have that be a separate part of your portfolio, or do you want this to be a full-time gig? I think a lot of people getting started just go, well, I heard it was good, let's just throw this at something and see what sticks. And there's no plan, or there's nothing on the board to throw at. And so I think that's extremely wise, what you said.
For a lot of my investors, their time is better spent building their business or climbing the corporate ladder. The people that are coming to me, their time is better spent if they're making $200,000 trying to go get to that C-level position and make $400,000 or $600,000 than it is chasing down a real estate deal, then not even get it. Or if they do get it, then maybe they're making below average returns or pulling their hair out. It's taking away from their family. It's taking away from their time spent in the deal. Or if they have a business and they have two different buildings and they want to go open up another shop, or they want to go up in some other location versus do another deal. So for me, I think the high income earners, figure out how you can get passively invested. And for the lower income earners, for me, high income earners, I think is $200,000 or more. I would say that's a good amount. And then below that, I would say we're trying to, you probably want to get active. I think single family is a good place to start. I think house hacking is one of the best ways for people to get started, and I think the duplex, triplex, quadplex market is kind of saturated. So I think because everybody wants to go after that, that's people that are living in it and people that are not living in it. Just get a big house and rent out some of those. You don't have to. It doesn't have to be 2 to 4 doors. You can get a house and rent out some of those doors, and you're building up equity. You're getting a taste for real estate. People are paying down your mortgage while you're building your book of business or whatever you're building. So I think that's a good way to start.
Oh yeah. Did it kind of wrapping up here? What would you suggest to the audience? A book or two to read, to pick up, an audio book or something that you found hasn't been influential for you?
For me, it's been like a lot of like success for real estate. It's very real estate specific. It depends what real estate vehicle they want to get into. Mm-hmm. So single family, Brandon Turner has a lot of good books on that. The book on rental property investing, mm-hmm. he has that. It's pretty good general book on rental property investing. Yeah. I would say that's a really good one.
And you have a book as well, correct?
I don't have a book.
I thought I saw like
future coming, or
maybe one day.
I saw something on your website.
I have ebooks and stuff like that. So we on our website we have ebooks for like multifamily resources and everything like that. So I break down what it looks like investing in 401k versus putting it in multifamily. So get specific on your real estate. For me, I like a lot of success books, and like I've read Think and Grow Rich 100 times. I've read, How to Win Friends and Influence People. I like Grant Cardone. His real estate advice is kind of all over the place, but you can't hate on his sales advice and like hustle. Like he works his butt off. Mm-hmm. So like when I was in sales, I'd listen to the 10X rule. I think Rich Dad Poor Dad's a classic. For real estate in general. I think that's a great one.
Yeah. Brian, do you guys have anything else? Good role? Be still?
No, no surprise at your success and what you've been able to do. And I think it's, a testament to like, you still have zero complacency, it sounds like, in your business and what you're doing and how to grow. And I think we see that similar in other guys that are successful. We had Jared Martin on the show pretty recently. I don't know if you know him or not, but same thing. He's just...
That was a connection.
Every day pops in. Yeah, there you go. So every day pops in and puts on some Grant Cardone and gets himself hyped to dial the phones. So like that's what it takes, even at his level, even at your level, to continue to have success and grow. It takes that turn off the complacency. So
it does. Brian, thank you so much for coming on the show. Guys, thank you for listening in. We have April 3rd. We have guest Tyler Casey coming on, so keep listening in. Brian, thanks for coming. Wealth of knowledge. We appreciate it.
Thanks, guys.
Appreciate it, man.
Love you guys.
Love you guys.